Right. I think for the sake of time, we will get started. I think people will be dribbling in, but they can certainly miss my introductory remarks and not take away from the webinar. So welcome everybody to the first of what I hope is a series of webinars that Ben Franklin wants to host on topics important to startup and entrepreneurs. So consider this, step one in a series of presentations that we'll try to maybe do monthly. What we hope to do in these presentations is to provide content to entrepreneurs of relevance to their companies. And then also, more importantly, we want to be able to connect these companies to key resources in our ecosystem, in our Philly ecosystem. So we'll provide content, provide info, but we'll also provide that nexus of contact. And we want to help grow this Philadelphia ecosystem. We have a lot of great resources here. Andrew and KPMG will be hosting our session today, but we want to continue that quest, to match our companies with the resources needed to grow. But what I'd like to mention is this session will be recorded. Although it's live streamed, we plan to develop a resource page and we'll archive presentations in the future. So we will be recording this for future archival purposes. Definitely want to thank Kate and Nicole who are on the call. They helped with all the details for this webinar, and hopefully we'll be able to rely on them for help for future webinars as well. What I would ask everybody as they start joining into the meeting would be if you have questions, please use the chat function if you could. I will be monitoring the chat function. I'm not sure if I'll interrupt the speaker for questions or wait to the end. I guess we'll just see the flow of the questions, but again, please use your chat function for doing that. What we haven't arranged is any kind of feedback, but certainly looking for feedback. We don't have a survey or anything, but I'm very interested in your feedback, not only on Ben Franklin doing more seminars, but on this seminar today. The other thing I'd like to get feedback on, since this is our first one, is time of the day. So we were sort of debating, is this like an early morning thing, or it should be a midday thing, or a late afternoon? We had no idea. We shot for mid-afternoon, but for future events, if you think there's a better time that resonate with you as an attendee, I'd love to hear that. So I guess with all that as sort of background information, I'd just like to dive into the presentation today. And thanks to Andrew and his team at KPMG. We're going to talk a little bit, and Andrew's going to lead the discussion on the topic of tax and accounting for startups. I have a lot of companies in the portfolio that sometimes tell me, well, I don't have to worry about taxes because I'm not profitable yet. But tax consequences start hitting companies early on, and I think this is going to be an educational system or an educational seminar to talk about, how you should think about taxes in your company going forward. Depending on the need and the interest, I think Andrew and his team have actually just arranged that maybe a week from now or so, Andrew, you can introduce this. They're certainly willing to have an office hour. So if you want to have more detailed conversations with Andrew and his team, they're willing, and Andrew, I'll let you talk about timing and everything of an office hour. So they're willing to even do more than just the chat function might allow today. So with that as preemptory remarks, let me pass it on to Andrew. We'll talk a lot about tax and accounting for startups. So Andrew, I'll give you the calm.
Great. Thanks a lot, Mark, and I appreciate everybody's time for participating. So again, KPMG, we're a big accounting firm. Our three main service lines are audit, tax, and advisory. But Steve, Ross, Ryan, my co-presenters, and me, we all work in KPMG's strategic channel called our private enterprise group. And what our private enterprise group is, one of the types of companies we work with are emerging growth companies that are backed with venture capital, private equity, and we get into companies that are bootstrap, funded with angel capital and seed capital. And look, the reason we're doing this is that we're a very big supporter of Ben Franklin and the impact it has. And really, this is our contribution to the emerging growth ecosystem in the region. We want to use this as an educational session. And then as Mark indicated, what we'd like to also do is if anybody wants to spend one-on-one time with us through these office hours, Mark will give you my email address. You can get in touch with me directly and we'll set up private sessions with you to get more into the details. Because what we're going to do is we're going to spend time on a couple topics here We have a presentation that's going to be up on the screen. We're not going to go through all the slides, but what we're going to do is spend a fair amount of time on some key topics that we think you're going to be interested in. And the key topics are: number one, choice of entity. We know you guys have already formed businesses, but the question is, if you're a limited liability company, what are some of the objectives, and do you want to switch to a C Corp? So we're going to spend time there. Steve's going to spend time talking about state and local taxes. And as Mark indicated, all of you are a very early stage. So you're probably not making money yet because you're growing your business, your service, your product. So you're probably not paying taxes, but there are transaction taxes like sales taxes that you have to consider, and Steve's going to cover that. Ryan's going to talk about certain books and records topics at the end. And right now we're going to pivot a little bit. Ross is going to cover some tax credits and incentives to kick this off. He has a commitment towards the end of the meeting. So we're going to let Ross go first and talk about some tax credits and incentives. So can we turn, Mark, to maybe page 19 of the slides, and we'll let Ross take it from there.
Thanks, Andy. Can everyone hear me?
Okay.
Yep. Okay,
Can
good.
everybody see the screen?
Yep, yeah, it looks good.
Yep. All right, so thanks everybody, and welcome to the presentation, and appreciate your flexibility in us going out of order a little bit here due to a last minute commitment. So as Andy indicated, we're going to start with the topic of tax credits and incentives. And just to take a step back, just to make sure we're all on the same page, let me quickly define what a tax credit is, and because it's different than a tax deduction. So tax credit is, in the example you see at the bottom of the screen, if you owe taxes of $10,000, but you have a $6,000 tax credit, now instead of paying the government the full $10,000, you're only going to be paying them in $4,000. So it's a dollar for dollar reduction in the amount of taxes that you owe to the government. Now, as Mark alluded to during the kickoff, a lot of you companies might not be profitable and therefore may not be paying taxes. So what I'm going to do on the next several slides is go over some of the common tax credits, but not just talk about what those credits are, but let you know how you can monetize those credits, even if you're not in a profitable position and therefore not paying taxes. So to start, the most common credit that's out there, and one that most companies that we work with claim, is the research and development tax credit. So that's a credit that's been around since the 1980s, and it was enacted by Congress as basically a jobs-based credit. So they wanted a way to incentivize companies to keep highly skilled technical jobs in the US. And it's a credit that allows you to recover between 6 to 8 cents of every dollar of your qualified research and development spend. Let me quickly define what research and development means, because it's very broad. Traditionally, if you hear R&D, you think of people in white lab coats doing experiments in labs. And while that is certainly R&D, what also is R&D is software development. So if you're developing software as a service or software that you intend to license, that could qualify or be considered research and development. If you're developing software for your own internal use, so you're developing a system to help run your business, that could qualify. So software is one bucket. If you're developing a manufacturing process, that could certainly qualify. If you're improving a manufacturing process, that could qualify. If you're developing or improving a product, that would qualify. Basically, anything that relates to developing or improving a product, a process, computer software, a technique, a formula, a know-how. The point is, R&D for purposes of this credit is very broad, and most companies that we talk to conduct R&D in some form or fashion. So in determining the amount of credit that you're eligible for, there's 4 types of costs that we would look to qualify that get included in your credit calculation. The first is the wages of any of your internal employees that are conducting R&D or that are supporting the R&D effort. So a lot of times we'll meet with companies that are developing computer software, and they'll have on staff a couple coders and developers who work, day in and day out to develop the platform. But besides just the people actually doing the development work, If there's people within the organization that are supporting them, so people helping to develop the business requirements or do the alpha and beta testing, quality assurance testing, etc., their time contributing to that could also count. So internal wages are the first form of expenses that can count towards the credit. The second is any third-party spend. So if you're using a third party to assist you in your research, so they're doing the development for you, they're doing the quality assurance testing for you, they're doing other forms of testing for you, the amount that you pay them can qualify as well. The third type of cost is materials and supplies that are used in the R&D process. So that's not as applicable when you're talking about software development, but if you're more of a traditional company that develops a product or processes, if you're consuming materials and supplies during your R&D efforts, those count towards the credit. And then lastly is what we call computer sharing. But if you're paying a third party to host a development environment in the cloud, that rental payment, those monthly rental payments can count towards the credit as well. Just a couple other important things I want to point out. We see this a lot with early stage companies. If you're being funded by a grant or by a customer for your research, that wouldn't count towards the credit, or the expenses that you're being reimbursed for wouldn't count towards the credit, because then you're never really at financial risk. And like I said, you generally get about 6 to 8 cents for every dollar of those 4 buckets of spend that we qualified. So now if you go to the next tab, so now you may be asking yourself, okay, that's great. I perform research and development, but I'm not profitable, so I don't pay taxes. What good do these credits do me? And the answer is Congress had that same thought back in 2016. So I mentioned the R&D credit was enacted in the 1980s, and it took them all the way until 2016 to realize that while this R&D credit is great, it's really mostly benefiting really large companies and not so much early stage startup or smaller companies. So what they did was they changed the rule and they said, if you're what's deemed to be a qualified small business, and I'll define that in a second, you can compute the research and development tax credit just like you normally would, but instead of using your credit to offset your income taxes, which you're not paying, you can use it instead to offset your payroll taxes. So that means if you have employees and you have Social Security withholdings, you can use your R&D credit to offset the amount of Social Security taxes you're paying on behalf of your employees. So what that does is it gives you the ability to more immediately monetize these credits and get more cash in your pocket. And you can claim up to $250,000 of payroll tax credit per year. So I mentioned that this is only applicable to qualified small businesses. So let's define that real quickly. A qualified small business is one that is less than 5 years old and is one that in the current year will not have more than $5 million in sales. So if you fit within those two criteria and you incur R&D expenses, chances are you're eligible to use this payroll credit. Now, let's say you incur R&D expenses, but you don't meet the definition of a qualified small business. That's fine. You can still compute a credit. You just will use it to offset your federal income taxes, which you're either paying now or in the future up to 20 years. So you can carry the credits forward up to 20 years. If you move to the next slide. So everything I was just talking about is a federal income tax credit. What this slide shows is that many states across the country, including Pennsylvania, have their own version of an R&D credit to incentivize companies to keep those highly skilled technical jobs in the state. So companies can claim both a federal credit and a state credit, assuming that the state that you're operating in offers one. Pennsylvania happens to offer one. What's very unique about Pennsylvania is if you compute a credit, but you're not paying taxes in Pennsylvania, again, because you're not profitable, they actually allow you to use a broker to sell your credit to a profitable company. And you can get about 90 cents on the dollar. So again, similar to the payroll credit, this allows companies who are operating in Pennsylvania and doing R&D in Pennsylvania to put more cash in their pockets by selling their credits to other profitable companies. And then the last thing I want to mention on the next slide is, so the R&D credit, like I said, is probably the most common and one that we see the most, especially in early stage startup and smaller companies. Beyond the R&D credit, there's a whole host of other federal credits and incentives and state credits and incentives. So what you see in front of you is just a listing of some of the state credits and incentives that Pennsylvania offers for companies to do work in Pennsylvania. I won't go through and read all of these. The point is, I want you to know that there are credits and incentives out there to be had if you know to look for them. But the other important thing to note is some of these are what we call statutory credits, meaning you're eligible for them, assuming that you fit the criteria. But some of them are what we call negotiated credits, which means you have to work with the state to negotiate them giving you one of these credits. So an example would be if you have a few employees, but you plan on growing, and so you want to find space to house all of your employees, you would make the state aware that you're interested in setting up shop permanently in Pennsylvania, and then you would work with the states to figure out what sort of incentives they can provide you to help basically use it as a carrot to get you to commit to Pennsylvania. One caveat here, though, is because of what's going on with the economy right now and because of how strapped a lot of states are for cash, because these are more discretionary or negotiated credits and incentives, we have seen that the states are kind of clamping down a little bit and they're not being as generous in their offerings. We have heard recently that they're starting to open up their pocketbooks a little bit more again, but nothing is 100% certain. The important thing to just remember is those credits and incentives are out there to be negotiated. And so if you do plan on setting up more of a permanent shop in the state, it's worth having a discussion with the state to see what they can make available to you to incentivize you to do your work in Pennsylvania. And with that, I think I will turn it back over to Andy.
Great, thanks, Ross. Mark, did any questions come up for Ross while he was giving his presentation?
Right now, none.
Okay, great. Okay, thanks, Ross. Mark, could you go back to slide 4?
Yep.
Great, thanks. So again, one of the first decisions that a company needs to make is its structure. And structure is important because it really determines how a company is taxed. Now, we understand that all of your businesses have been formed and you have a specific structure. But what I'm going to get into is a couple real live examples on companies that perhaps were set up in one way, for example, as a limited liability company and converted to C corporation, or companies that didn't do that. And what the examples are really going to underscore are how these companies are taxed, a C corporation versus an LLC, and some of the pros and cons and advantages and disadvantages of being a limited liability versus a C corporation. So Mark, if you could go to slide 6. So here's the real live example. So the first example is company A was formed as a limited liability company and subsequently changed to a C corporation. The shareholders of A met the qualified small business stock requirements and each excluded $10 million of gain when they sold their stock. So the key point here is the tax code contains a section called 1202 that's qualified small business stock. And to the extent certain criteria are met, the owners of the company, when they sell their business to either a financial or a strategic buyer, they can exclude, again, the greater of $10 million or 10 times their basis. So this is a very, very powerful tax planning tool if you're set up as a C corporation. So the key is for a company to qualify, when an owner is issued stock, the company has to have had under $50 million of gross assets, which we're assuming at your early stages you do. Certain trade or business requirements have to be met, which we're assuming they do. The key is you have to own your stock for 5 years. So if you're issued stock today, either through cash or the exercise of an option, and you hold it for 5 years, you sell your stock to a strategic investor at a gain, you may be able to exclude 100% of that gain from taxation. So a very, very powerful tool, Section 1202, qualified small business stock, that all of you that are set up as C corporations should pay attention to. And again, in this example, the limited liability company converted to a C corporation. If it remained a limited liability company, the owners would not have been able to enjoy this tax benefit because it only applies to C corporations. So the next example is we had a client that was formed as an LLC and changed to a C corp when it raised its first rounds of institutional financing. And the only point here is if you're a C corporation, a lot of institutional investors will not invest in limited liability companies because of the type of income that they throw off. So the point here is if you're a limited liability company, you may have no choice but to convert to a C corporation when you raise your first institutional round. The third example is Company D was formed as a limited liability company and incurred losses for the first 3 years. D converted to a C corporation in year 4 and had profit in year 5. So a limited liability company does not pay tax. Rather, its profit and loss is passed out to its owners. So in the example, the losses incurred in the first 3 years, they were passed out to the owners, and the owners reported those losses on their individual tax returns. The company then converted to a C corporation, incurred a loss in year 4. Since the company converted to a C corporation, that year 4 loss can be carried over. So in year 5, when the company had a profit, only the year 4 losses could be carried forward to offset that profit, because again, the first 3 years of losses flowed out to the owner. So the key point here is if ultimately you're going to have to convert to a C corporation for whatever reason, or if you want to convert to a C corporation because of this qualified small business stock exclusion, you may want to convert sooner rather than later to preserve those losses in the C corporation context. So those losses can be captured there, carried forward, and they can offset C corporation profit in the future. So again, the key point here is if you incur losses as a C corporation and you ultimately, as a limited liability company, and you ultimately switch to a C corporation, those LLC losses aren't going to be able to be used, versus if you're a C corporation the whole way, losses can be carried forward. So the next example is Company E was formed as a limited liability company and remained a limited liability company until its sale to a buyer. Company E was able to negotiate a higher purchase price because of the tax benefits that the buyer would realize. So this example underscores the flexibility of being a limited liability company. And the point here is that a buyer in the limited liability context can buy equity and will be able to write off its purchase price in the future, thereby gaining tax benefits. And in this example, our client was able to negotiate a higher purchase price because of the present value of the future tax benefits that the buyer would gain. So it was able to leverage its structure to attract a higher purchase price. Conversely, in the next example, Company F was formed as a C corporation and sold. In this example, the buyer was not able to write off its purchase price because it was a C corporation, and a C corporation, the assets of the company remain unchanged. And since the assets of the company remain unchanged, the buyer wasn't able to write off or amortize its purchase price. And as a result, the buyer decreased its purchase price for the present value of those future tax benefits. So the key point to be made here is that whether you're a limited liability company or a C corporation, it's going to oftentimes dictate the structure of your exit, and it may dictate your purchase price. And it really depends on who your buyer is. So if your buyer is a strategic buyer, the buyer may not necessarily be concerned about cash flow. They may be more concerned about EBITDA. So they may not reduce the purchase price. But oftentimes we see if the buyer is a financial buyer, a private equity fund who's more cash flow driven, and those future deductions, being able to amortize purchase price, will help manage future tax liabilities. They may be more concerned about being able to write off purchase price. So again, the key is based on how your structure is often going to dictate your exit and what a potential buyer is willing to pay. The next example is Company G was formed as a limited liability company, and due to the complications in operating as a limited liability, the company converted to a C corporation. So when we talk about complications, there's a bunch of complications. First of all, limited liability companies are a bit more complicated than C corporations. First of all, a limited liability company has to issue a K-1, because as I indicated in the beginning, limited liability companies don't pay tax. Rather, they pass their income or loss out to the owners. So the owners have to take this K-1 and report the income or loss on their personal tax return. To the extent there's income that passes out to the owners, the limited liability company generally has to make tax distributions. So the owner pays tax on that income. In addition, one of the key items is an owner of a limited liability company also can't be an employee. So that means if you're an owner of your business and it's a limited liability company and you also provide services, you can't get a W-2. And if you can't get a W-2, the way you're compensated is in the form of a guaranteed payment. And a guaranteed payment doesn't attract withholding. So you're on your own to make your own estimated tax payments, and you're on your own to pay your own benefits. So the point is, if you're an owner and a service provider of a limited liability company, there's a lot more complications in operating that way because of the fact that income is passed out to the owners and you can't be treated as an employee. So in this situation, our client didn't want to undergo the complications because it issued equity to its rank and file, and the rank and file had to deal with K-1s. They couldn't continue to get salary, and it just became much too complicated. So that company converted to a C corporation, and again, it gained all the other advantages of C corporation we just went over. The next example is Company H was formed as a limited liability company and has been profitable since inception. The company needed to retain its profit to grow. So the company considered converting to a C corporation because C corporations rates are less than the individual rate. So again, the tax rate of a C corporation, the highest tax rate is 21%. Limited liability company, again, doesn't pay tax. Rather, it passes out income to its owners, and the owners pay tax on that income. The individual rate can range anywhere from 25% to 39%. I'm sorry, 37%, with 37% being the top rate. So we helped this company do some modeling, and what the modeling indicated that if they converted to a C corporation, they'd be paying less tax than the amount of tax distributions they'd have to make to the owner. So they were able to minimize their taxes and retain cash in the business to grow. So they converted to a C corporation, again, because it yielded a better overall tax answer and less of a tax burden. And the last example is that Company I was formed as a limited liability company and is very profitable. Company I would like to start distributing profit to its owners. So Company I is going to remain a limited liability company because it's able to distribute those earnings tax-free. So for example, again, limited liability companies don't pay tax. Rather, the owners pay tax on the income. So a limited liability company earns 100, passes that income out to its owners. They pay tax on that income. The $100 can be distributed to the owners tax-free. Whereas if the company was a C corporation, C corporations pay its own tax. So that 100 would be taxed at the corporate level, $21, and then the after-tax proceeds of $79 would be distributed again, and it would be subject to tax again at the individual level. So the point here is that the company was able to distribute profits, and it was able to distribute profits in a tax-free manner. So again, these are just some examples of the taxation of a limited liability company versus the taxation of a C corporation, and some real live examples of why companies that were originally formed as limited liability companies chose to convert to C corporations, and some of the advantages that some of these companies did in fact gain if they remained as limited liability companies. So Mark, let's go to the next slide. So I want to touch on compensatory equity. And compensatory equity is really a powerful tool to attract and retain employees. And the reason is because you're giving out equity in the company and you're really aligning the interests of the employees with the growth of the company. So as the company grows, the value of this compensatory equity grows, and on an ultimate exit, your employees will be able to share the upside of the growth and the value of the company after they receive their equity. So if you're set up as a limited liability company, you can issue profits interests, and profits interests just give the owner the right to future profits. So again, if the company were to exit 3 years down the road, the individual owning the profits interest would get to enjoy some of the upside from the date of issuance. The tax advantage of having a profits interest is when it's issued, you don't have to pay tax on it. So a profits interest, the IRS has ruled, isn't susceptible to valuation. So you don't pay tax on the equity when it's issued. Again, the only downside is that, as I mentioned before, if you own a profits interest, you have to be treated as a partner, and you can't be treated as an employee. So the complication is the owner of the profits interest is unable to be paid wages and is going to have to get guaranteed payments, which introduces the complication of the owner paying its own taxes on that compensation and not having taxes withheld like it would be if they were paid through a salary in the form of a W-2. So in the corporate context, there's two types of compensatory equity. There's stock options and restricted stock. And the key economic difference is that stock options you have to pay for, where restricted stock, it's just granted. So for example, a stock option gives you the right to purchase stock in the future at a particular amount. So for example, you grant stock today when the value is 5, the strike price has to be 5. And when the stock is exercised, if the price is 8, you pay 5 for the stock, and there's ordinary income, compensation income of $3, which is the difference between the value and the strike price. Conversely, restricted stock, you don't have to pay for. So the advantage is that if you grant your employees restricted stock, they don't have to pay for it. So there's an economic benefit. And restricted stock is what we typically see C corporations issue because of the economic advantage in that your rank and file employees don't have to pay for it. The other advantage is when you issue restricted stock, as it vests, the person has to pay tax on the value at each vesting date. But there's an advantage with restricted stock. There's an election that can be made that when restricted stock is issued, and the restricted stock may be issued early on in the company's life cycle, when the value is low, that the employee can elect to be taxed on the income today at a much lower value, pay tax today. And then again, the advantage is all the future appreciation is taxed at a more favorable capital gains rate. So again, the two types of compensatory equity are restricted stock and stock options. The key advantage here is that restricted stock doesn't have to be paid for. And again, we typically see our clients that are C corporations issue restricted stock because it's easier to manage and it's less burdensome for the employee. So now we're going to get into talking about some state and local tax items. So Mark, if we can go to page 16, Steve's going to talk about state taxes and sales taxes.
Thank you, Andy. So far, we've heard some points regarding the taxation of different entities under a federal context. Like now, I would like to spend a little bit of time talking about the state and local considerations. Like in today's environment, it is very uncommon for like a company to operate like only in one jurisdiction. Like if you think of the proverbial example of a mom and pop grocery store that could be located in one town and have owners living in the same town, like all the customers would be in the same town and all the employees would be in the same town. Like in today's environment, it is like highly unlikely that you would come across a business that would have all of its operation just in one jurisdiction. But what you're more likely to see is a company that is incorporated in Delaware, having an office in Pennsylvania. A few founders could be living like in Pennsylvania, New Jersey. Employees could be logging in like online all over the place, and customers like once again could be located like anywhere. So it is very important to constantly evaluate the state and local profile of your business to make sure that you're in compliance with the state and local filing requirements, like in the context of the income tax filing. The states get jurisdiction to tax a company like based on activities that a company has in a particular state. And that could be either physical presence or agency or attribution or like in some cases, economic nexus. The most common one to keep an eye on, like in today's environment, the employees are working more and more remotely. Your payroll services providers may be withholding like state and local taxes for those employees like in the jurisdictions of their residence. And like states often have the cross-checking and matching programs. So it is not unlikely that you may be getting some correspondences like from these states looking for the income tax returns. Also, it's important to keep an eye on the context of economic nexus. Like more and more states impose a requirement to file income tax returns. Like if your revenue stream like associated with that state exceed a certain dollar amount, let's say 500,000. Like also like on these slides, it's important to note that anytime like you have an agency relationship, if somebody is selling your product on your behalf, or if somebody is distributing the product on your behalf, like even though you are not physically in that state, like you might also have a filing requirement. So like once again, like we can't possibly go over like every possible scenario that could create a nexus in a state, but it is very important to keep an eye, like anytime you have a new customer or a new employee or a new agency relationship, the question to ask is whether or not it will create like nexus in that state. Also on this slide, I would like to mention taxes that are not based on income. Like for example, New York has franchise taxes, which is taxes on your assets, something that may be on your balance sheet. Like if you receive a significant amount of funding and you're located in New York, like you may be subject to New York capital-based tax. And also like staying on New York, New York also has minimum taxes, which are based on your sales. So like in addition to income, that there may be non-income taxes that states may like to impose like on your business. Filing in additional jurisdiction, of course, creates an administrative burden. But one positive that may come out of it is while your business is still in a loss position, it may be an opportunity to harvest some net operating losses in multiple states, so that when your company does turn to profit, you may be able to use those losses to offset future income. And let's go to the next slide. Could we go to slide 17, please? Okay, so so far, everything that we mentioned related to income taxes. And like some of you may say, well, my company is not profitable, so I will probably not be subject to income taxes. And like some of the minimum taxes or franchise taxes may either be material or don't apply to me. So we're strictly talking about administrative burden. But with sales taxes, that is certainly not the case. These are taxes that are imposed on your revenue stream, like not on your income. So as long as you sell anything, you potentially may be subject to collecting and remitting like sales taxes to state and local jurisdictions. And when we think of sales taxes, up until recently, most states applied a physical presence test to determine whether or not a company is subject to the local sales taxes. For example, if you have a Home Depot in Colorado, obviously all Home Depot Colorado sales will be subject to the sales tax in Colorado. But in 2018, there was a landmark case, Wayfair versus South Dakota. Like Wayfair is as some of you may know, a catalog sales company, which did not have a physical presence in South Dakota. Nonetheless, South Dakota ruled that the state has the right to tax Wayfair sales with the minimum requirement. I believe that the decision was as long as they have like either 200 individual sales or the amount of sales in a state exceeds 100,000, like specifically to South Dakota. But subsequent to that, I believe up to date, 26 other states adapted the Wayfair standard. So today, most likely you don't need to physically be located in a state to be subject to the state sales tax. And when we're talking about sales, like we're talking about much more than just tangible personal property. States realize that in modern environments, companies have multiple revenue streams, which could be software, which could be services, which could be access to online platforms, which states are now trying to impose like sales taxes on. In the context of trying to make up some of the lost revenue from businesses moving like virtual, like other than like bricks and mortar, like under the old context. So it is very important to keep an eye like on collecting sales taxes, because state and local jurisdictions will hold businesses responsible for those taxes, even if they were not collected. To make a real live example, like Andy and I just had a situation come up with our existing client that was in existence for a few years before they came to KPMG, and that they're getting audited by one of the states in the context of sales taxes, and it's quite a cumbersome audit, because they're interested in looking at all transactions and the revenue streams that this company had like since inception. And today they're facing like really just two choices. They can either go back to their customers and collect sales taxes, which may not be such a great business idea, or they're on the hook for all those taxes. And those amounts can be quite significant. Like these taxes could be like 6%, 7%, 8%, like depending on some jurisdictions, and depending on what your profit margin is, that can have a significant impact, but to your bottom line if you don't collect them and remit them timely. So this is definitely something that to keep in mind, like from day one. Like as soon as you begin having any kind of revenue, any kind of sales, like you should consider sales taxes. And let's go back to Andy.
Yeah, and just to underscore sales tax, look, in today's environment with everything that's going on, states are really struggling for revenue. And a lot of, the companies that really generate the commerce and fund the economy are small businesses, growth companies like all of you that may not necessarily be making money now. But again, as Steve mentioned, every single company that has revenue has to take into account sales tax. And again, it's become even more important because of this Wayfair decision that Steve mentioned, which gives a lot of states a greater right to tax revenue, even though the company isn't located in that state. So, our recommendation is if you're not considering sales tax, that you do consider it and have a professional help you evaluate what your revenue streams are, where you're doing business, and whether those revenue streams are subject to sales tax. And again, there's no economic outlay from the company that's selling the product or service because the sales tax is collected from the customer. Rather, you're just an agent for the state. But again, as Steve mentioned, failure to collect sales tax could put the burden 3 years down the road on you if you haven't collected from your customer. So again, we can't underscore the importance enough of really paying attention to sales tax. I think Ryan's now going to talk about some observations we have on keeping an accurate and copious set of books and records, even at this early stage.
Thanks, Andy. And Mark, if you just wanted to go on to the next slide. So this is from a slightly different spin from the tax group. So I work in the audit practice, but also in this private enterprise group that deals with a lot of startups and development stage companies, growth stage companies. And so we have experiences working with companies at a very early stage, all through their growth into potential IPO transactions. And one of the common things we see trip up some companies sometimes or create kind of a length of time when trying to execute a deal is if management does not have an accurate set of books and records or hasn't been keeping up with accounting for large transactions or significant agreements entered into, whether it be a supply agreement, some sort of partnership agreement for some sort of milestones or revenue recognition, debt, equity. So really want to highlight the fact that as you're entering into large transactions, it's worth discussing with a professional service provider, whether it be, your audit firm, or potentially there's a lot of consulting firms who do work with businesses at your stage for prices that are palatable, to get those transactions accounted for correctly as it's happening. Because what we'll find is down the road, when someone wants to enter into a debt agreement, there could be financial covenants that are linked to GAAP reporting. They could have requirements to have an audit by a certain date. Also, just when someone goes through and maybe with an M&A deal or due diligence surrounding your business, they're going to want to know what the GAAP results are. Obviously, we understand the key being EBITDA and, the non-cash items, which a lot of these accounting matters relate to, aren't necessarily impacting your day-to-day decisions. However, there is an expectation that those are accounted for correctly, and you just wouldn't want to lose sight of that as you grow and have that delay a potential deal down the line. So some things that we have noted here, also, if you think about, and I think we're on the wrong slide, Mark, but if you go down a few more to 23 or 20, yeah, 24. So some other things when you think about the importance of keeping accurate books and records, just as you're managing your cash flows, without an accurate assessment of your accounting books and records, it's going to be tougher to forecast your results accurately, as well as try and manage the cash flows for the business. A lot of times we see right now investors and boards are asking companies to really tighten the screws or show me how long you can make this cash last. Without a strong control over your accounting books and records, it makes that process harder. And it's good to just start early establishing, the groundwork for strong accounting processes. And then lastly, I'll just point out that, from our experience working with companies of your stage development, a lot of times Big Four accountants might not be who you're going to bring in to the door to help you right out of the gate. However, I will put it out there that there is value to having Big Four involved, whether it be from a tax perspective and then eventually into the audits, if you're thinking about growth years down the line. Because what we find is if you're going through an M&A transaction or an IPO in the future, a lot of times the underwriters or the underwriters council are going to require a Big Four auditor involved in the job. And at that point in time, if a smaller tier firm has audited any of the years that would go in the registration statement, the first action would be any Big Four that you would bring in would have to re-audit every year that would go in the registration statement, which just creates duplicate effort and duplicate expenses for the business. So really just throwing that out there to highlight the importance of thinking about where you plan to be in a few years. And if it is going towards one of those transactions, really thinking about, is a Big Four requirement going to happen in the future? And maybe it makes sense to consult someone at those businesses and see what they're willing to offer as far as a competitive rate to do the work for you. Because one thing I'll highlight is in our group that we have here at KPMG, we do work at a rate for these types of companies that's far discounted from what you would think for, a GE or a Pfizer or something along those lines. So I would encourage you to still bring Big Four into proposals when you're thinking about audits, because for one, it's just important to have more eyes on your results, but also you might be able to get a price that you didn't think you'd be able to get. So I do think there's value in that. So if you want to go on the next slide, Andy, I know that this kind of leads in. One thing that we've been that we talk to companies about is their method of maintaining their books and records, and this KPMG Spark program is an option for you. So Andy, I'll turn it back to you to discuss this section.
Great. Steve, you want to cover Spark real quickly? And then maybe we have a couple minutes for questions.
Sure. So a couple of years ago, KPMG identified the need in the market for a platform that would help young companies keep accurate books and records. And we acquired technology and developed it further, with machine learning, to create a platform called KPMG Spark, which is basically like some of my colleagues like to say, it's QuickBooks on steroids. It's a platform that is linked to your bank accounts with a machine learning technology built in that every 4 hours reconciles your bank account and creates financial statements, so to speak, that will give you the real-time visibility into how your business is doing. Could we go to the next slide? So the KPMG Spark, it's a pay-as-you-go type of service. I think the pricing starts with at $200 a month, like depending on like how large like your company is and like how many bank accounts like you have, and I think it's also based on like the overall like scale of transactions that are taking place. But an important thing to mention is like in addition to the platform access, you will have a designated bookkeeper. You will not be calling some call center located who knows where, but you will have a person to contact so that if you have any kind of like accounting questions whatsoever, you can speak with that person in real time. And in addition, being a subscriber to KPMG Spark gives you access to the broader like KPMG network, which includes all of us on this call. And the presentation of the financials or the outputs from KPMG Spark can directly be linked to your tax return and the information that your tax preparer would need, like at the end of the year, to prepare complete and accurate tax returns. So, and do we have the next slide? No, I think we pretty much covered it all. So, yes, I think we did cover all of this.
All right, well, thank you. Let me just say that a couple comments came up. And first, before I say that, thank you so much to Andrew and his team. But a couple comments. First was, like myself, a lot of people are drinking from the fire hose in terms of content, and wanted to know, those, you know, unless you live it every day, this is a lot of information to digest. And so thanks to Kate for replying that, you know, we are recording this, so we'll have it archived. Secondly, you know, if there are questions, please let me know. We'll connect you with Andrew. Andrew, you know, agreed with his team to do office hours, so you can delve in, ask some questions, you know, more personally rather through this chat function. So those that are interested in connecting with Andrew and his team, please let me know, and we'll certainly send you his contact information. Finally, there was a question, and it really was about the sales tax is an interesting one, and I was learning as you're going. But it's really about, you know, can a company absolve the responsibility of state sales taxes by basically saying, you know, if there's a clause in a contract that's submitting sales taxes, the responsibility of the customer or client, does that prevent the business owners from having to do it themselves?
Yeah, I mean, that's an interesting question, and you can certainly negotiate something with your customer, but the company selling the product or service has an obligation, and the obligation is to collect sales tax. So if the company doesn't collect the sales tax and they're audited, the state's going to say, okay, well, you didn't collect. We need you to pay it. So the point is, there's a legal obligation for the company to collect the tax as an agent for the state. So the fact that you're putting a clause in to your contract that the customer's going to self-assess and accrue doesn't necessarily absolve your obligation with the state. So the answer to the question is, no, it doesn't absolve the company's obligation. If they have a collection obligation, it doesn't absolve them.
Okay, thank you. Just looking at the time, I really want to thank folks for participating. Again, The invitation, if you want Andrew's contact information for him and his team to ask more specific questions at office hours, let me know. Thank you very much for your attendance. I'm mindful of your time. Any other feedback on the content, number one, or time of day as we introduce new seminars and webinars going forward? I'd appreciate it. And again, being very mindful of your time and patience, thank you, and thank Andrew and KPMG. If you have any other questions, please highlight it now. And if not, then if I don't see anything in the next minute, I'll wish everybody a great holiday season. And again, thanks to you, Andrew. And we'll follow up, Andrew, with anybody who wants your contact information. I'll get that to you. So thanks everybody for today.
Great. Thanks very much, Mark. Thanks for the opportunity. Thanks, everyone.
Thank you, everybody. Thank you so much. Bye-bye.
Thank you.
Bye-bye.